Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I am the branch manager here at Serving Those Who Serve, and Sipe and Associates. And I want to say thank you for taking the time to listen. And above all, thank you for your service. You don't hear it enough. You're going to hear it here. And also reminding you, stay safe and well. Take care of yourself. We need you. You are the glue that's holding everything together right now. We're back again, remotely and safely, with the guru, the incomparable Ed Zurndorfer, as part of our ongoing mission to reach, teach, and serve you. And as I've touched in previous podcasts, we are expanding that capability. Many of you have attended our live seminars each month for the last 5 years. Obviously, that would not be safe to do. So we've been working feverishly with Ed, converting content to a digital offering. So it will be live. You will be able to ask questions. It's going to be awesome. So stand by. We will have that ready to go within the next week or so. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, no matter how awesome they are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and should not be intended to be taken as advice. All listeners should consult their personal advisors before taking any action. Okay, Ed, in our last podcast, and we're continuing it here, you focused on Social Security for the articles in the Fed Zone, and you can find those at blog.stwserve.com or at fed-zone.com. And the title of this article, and this is we're to dedicate all our time to this, is Employees and Annuitants Should Be Aware of Their Options When to Receive Their Social Security Benefits. Okay? So in our previous podcast, we had the question for the ages, when's the best time? And as we already know, that's an unqualified, it depends. But now this is going to deal a little bit with claiming strategies. And believe me, Ed, just from our practice, we see this is the place where there are so many misconceptions because changes have happened. Changes have been taking place since 2015. And there's really no place for people to stay up on that unless they're out there searching on their own. So you do a great job digging into this, and you don't waste any time. You jump right in with something called the do-over option. So let's go in on that. What is do-over option?
Okay, Dan. I've been in this business for 30, 40 years. I see a lot of changes, but about 10 years ago, Social Security Administration got rid of the do-over option, and I want to explain what this was and what a great opportunity it was for the people who took advantage of it. The do-over option works as follows. Let's suppose an individual, and we talked about this earlier, started their Social Security at the earliest possible time, age 62. And we talked about the fact that if you take it at 62, your Social Security benefit will be reduced. So let's suppose an individual, again, this was before December 2010. The Social Security Administration allowed this to happen. An individual started taking his or her Social Security at age 62, and over the next 4 years until they reached, let's say, their full retirement age, they received a reduced Social Security check. How much? How was it reduced? About 25%. 25%. Okay. And in my example, I have an example where somebody did that. But let's say when that person reached age 66, their full retirement age, they said, gee, that was not a very smart thing I did. Yeah, I got my reduced benefit over the past 4 years, and I had this money, and I could invest it, use it any way I wanted to, but it was reduced, and it's going to be reduced for the rest of my life. I thought that when I reached my full retirement age, that Social Security would revert me back to the full amount. I just thought it was a temporary reduction. Not the case. When you decide to take Social Security at age 62, you are subject to a reduction that's permanent. This is for the rest of your life. Person has regret. Is there anything I can do to fix that? Well, before December 2010, there was. You could contact Social Security and said, I was wrong. I made a bad decision. Can I repay all the money you gave me over the past 4 years? And if I do, can you start me all over again at the full amount? Social Security said, yes, we will. Just give us back all the money with no interest, no penalties. No penalty.
That's
it's called the do-over option. And I can tell you, a lot of people took advantage of that. They took advantage of it because they had buyer's remorse when they did it at first. I mean, I always tell people that they could have used this money to buy a house, and then at age 62, and then 4 years later they sold their house at a huge profit and take part of the profit from the sale of the house and just pay back Social Security and then start all over again. Well, Social Security, effective December 1st, 2010, got rid of the do-over option. They said no more. They were losing too much money on it, I guess.
No, sure, absolutely.
There is a modified do-over, which I think we'll talk about it here in a few moments. But for all intents and purposes, you cannot do that anymore. You cannot pay back Social Security all the money they gave you. Might as well just say now what you can do now is that you're allowed to change your mind and pay back the money, but you have to do it within the first year. So if you took Social Security at age 62 and getting the reduced benefit, and you change your mind before you turn age 63, all you have to do is to tell Social Security, I'm changing my mind. Here is less than all the money you gave me, less than 12 months worth. Now, and I'll decide when I want to start again. But for right now, stop it. Just stop the payments. So they will allow you to start over, but it has to be that decision has to be made within the first year, the first 12 months.
Okay.
In order to get that.
And they're still paying some things back, correct?
Well, you have to pay back certain things. For example, when you got the money from Social Security, let's say you were over 65 and you were enrolled in Medicare Part B, Medicare Part D, that you pay, in which you pay your monthly premiums. Since Social Security took that money out to pay the Medicare premiums, you're going to have to pay that to Medicare. You're going to have to pay that. If they're giving you all your money back, you're going to have to pay back Medicare for the premiums that were taken out during the months that they withheld the payment that they're paying back. They took out the money for your payments. Also, some people have federal income taxes withheld from their Social Security payments. Social Security remits the the federal tax payments to IRS. You'll have to pay back the taxes that were withheld to Social Security, the money that was taken out for taxes. So again, the things have to be done with, in order to start over again, so to speak. But I want to emphasize, it has to be done within the first 12 months, whatever you did it. If you did it at age 62, you did it at age 63 or 64 or 65, before your full retirement age, you have to change your mind within the first year, in the first 12 months.
Okay, which if it was really a mistake, I think that's reasonable. Now, you do hit something here that's kind of interesting. So you say the question then becomes, are those individuals who started collecting Social Security retirement benefit starting after 2010, but before they reach their full retirement age, FRA, and have collected these benefits for more than 12 months, are they out of luck with respect to the do-over strategy? Your answer is not necessarily.
Not necessarily, because there's another option. Let me just mention one other thing that the person has to do if they're going to withdraw their benefits. If they're going to stop their benefits stop within the first 12 months, they need to fill out a form. It's Form SSA-521. This is in the article, SSA-521. 721. It's on the Social Security website, and you have to give a reason for withdrawing your application. Okay?
Gotcha.
You have to give, like, for example, didn't realize the reduction, something that Social Security will understand. Okay? You have to just on the application. Okay? All right. So now the question is, if you go beyond the 12 months, are you out of luck? And the answer is no, because there's something you can do to help alleviate the situation. I say that because you can, once you reach your full retirement age, you can suspend your Social Security check. You can suspend it. And what that means is you're going to stop the payments, and because you are stopping the payments, you've reached your full retirement age. We talked about in the last podcast something called delayed retirement credits. Your benefits will actually, since you're not receiving them, you're past your full retirement age, will get 8% per year increase. And once you start them up, you'll get the increased benefit built in wherever you left off. So, for example, suppose somebody, the reduced benefit when they suspended it was $1,000 a month, and they've reached their full retirement age, and they suspended it. Then they wait a year before starting them up again. Now their benefit will go up to $1,080 a month. They get the 8%. If they wait another year, there'll be another $80. That's $1,160. Until they reach their full retirement age, they can get the 8% built into their whatever their benefit was at the time they suspended it. Now, keep in mind they are suspending it, not withdrawing it. How do you suspend it? Well, there's no form to be filled out, believe it or not. All they got to do is call Social Security at 1-800-772-1213. Tell the counselor on the phone, I want to suspend my benefits. But they only can do it. They only can do that once they reach their full retirement age. They cannot do it until they reach their full retirement age.
Okay.
And then they can restate the benefits anytime by calling Social Security to start them up again.
Gotcha.
So there is a difference between withdrawing your application, which can be done anytime, as long as it's within the first 12 months. But when it comes to suspending, you have to wait till your full retirement age.
Gotcha. Okay, so and you sort of loop back on this in the article with the additional considerations before withdrawing an application, and you touched on it before. Let's get this out there because a lot of times people could be walking around going, "Oh, I'll just do this." Well, you may be listening to this podcast, folks, and saying, why is Ed telling me about something that went away? Because people still think these things are out there. And if you think it's out there and you're planning on doing that, and you have not had anybody explain it to you to the contrary, then you're going to be the person who claims and then in 2 years says, hey, I want to do this, and you find out you can't. So that's why we're going through it. So additional considerations before drawing the application within the first 12 months. You note that, hey, remember, you have to pay back what you brought, what you received.
Yes. Also, if you have a family member receiving benefits, a spouse or a child, their benefits will also be withdrawn. They're not going to get their benefits. The same thing with suspending it. If you feel a family member needs the money, you may not, but the family member needs it. And if you withdraw or suspend the benefit, that family member will also lose their benefits.
Okay.
Okay.
And then you need to repay anything that was withheld for premiums, correct?
For Medicare, that would be, let's say, for the spouse, not for the child, but for the spouse. Yes.
Yep.
Yes.
And now it was interesting in here. You say that if an individual's already entitled to Medicare benefits, they may choose to withdraw their Medicare coverage, but they don't have to do so, even if they withdraw the application.
For Medicare. That's probably, please understand that the Medicare benefit you're paying for, let's say Medicare Part B, the medical insurance, There is a premium that you pay for that, and out of convenience, most people pay that premium through a deduction on their Social Security check. If you're over 65, it's probably not a good idea to suspend your Medicare premium, because when you get back in, you're going to pay a penalty.
Gotcha.
What you should do is to tell Social Security, okay, I'm going to suspend my payment, but then make arrangements to have your Medicare Part B premium, and in some cases Medicare Part D, the prescription drug program premium, paid through a debit from your checking account. You don't want to get out of Medicare if you don't have a valid reason. Let's say you're covered by you're covered by a group plan, a group health insurance plan. You're working for an employer, and you're covered by their group plan. To get out of Medicare and then get back in, if you don't have a legitimate reason, you're going to pay a penalty when you get back into Medicare. Your premiums are going to be increased as a result of getting out of Medicare. So you want to make sure that you keep the two separate.
That's a great tip. So just to recap, if you're going to withdraw an application, that's Form SSA 521. And if you're going to suspend, no form, just call 1-800-772-1213. Now,
and then reinstate your benefits, same thing, you got to call.
Got to call, got it. Now, suspend, I can hear ears popping up all over the DMV as this is going out, because now people are waiting for us to get to the greatest loophole in history, file and suspend. Okay, so go ahead and jump into that. We're going to make some people cry, but it's important they know how stuff works.
Okay, let's review. We're going to get into file and suspend. We're also going to talk about something called restricting an application.
Yep.
And so before we get into, let's just review what's called Social Security's dual entitlement law.
Yep.
Under the dual entitlement law, a married individual is entitled to the higher of their own Social Security retirement benefit or a spousal benefit, which is equal to 50% of his or her spouse's, or if that person was married to a former spouse and the former spouse's Social Security benefit is more than half of the individual's benefit. Now, say that the individual is not remarried. But they have a former spouse, and the former spouse has a much higher Social Security benefit. They can get half of the former spouse's Social Security benefit. Okay, so the married individual, let's say we have a married individual, they file for benefit before their full retirement age, okay? In general, married individuals who file for retirement benefits before their full retirement age, depending, again, full retirement age depends on what year you're born, based on their own earnings record or spousal benefits. If they file before the year they turn, the month they turn FRA, or what's called, they are deemed to have filed for both benefits at the same time.
Mm-hmm.
They are deemed to have filed for both at the same time. But once a married individual reaches his or her full retirement age, some individuals, some individuals can what's called restrict an application to one type of benefit. We'll talk about that after we talk about file and suspend. So let's talk about file and suspend, what that's all about.
Yep.
Before April 30th, 2016, an individual who's fully insured upon reaching their full retirement age could apply for his or her benefit, no matter what the amount of their spouse's benefit was. They could file for their own benefit and then immediately suspend the benefit. They receive one check, and then they say to Social Security, I don't want the check, I'm turning it back. So what's going on here? Why did they want to receive the benefit? Because if that individual filed for their benefit, that would allow a spouse or a child under the age of 18 to receive half of the individual's Social Security just by filing. And then you'll say, well, they did, but then they changed their mind. They said, they called Social Security and said, I don't want the check. But under this file and suspend, the spouse and the child or children would be able to keep their benefit. Keep their benefit. They would not have to, those benefits would not be suspended. And now comes the real benefit. When the individual who suspended his or her benefit after receiving just one payment turned age 70, then that individual should file for his or her own benefit, and how much more would it be? That person would get the delayed retirement credits, we talked about this earlier, as much as 32% more in benefits because they actually waited to start taking their benefits. Again, this was true before April 30, 2016. Some individuals who happen to be born before April 30th, 1950, and I say that because anybody who was born after April 30th, 1950 was not able to take advantage of file and suspend. Mm-hmm. Remember what I said a few moments ago, Dan, that in order to do file and suspend, you had to have reached your full retirement age.
Yep.
Somebody born before April 30th, 2016, full retirement age was April 30th, 1950. Full retirement age is age 66. They would have turned 66 years old sometime before April 30th, 2016. If you were born after April 30th, 1950, like myself, 1951, our full retirement age happened to be after April 30th, 2016. We could not take advantage of file and suspend.
Gotcha.
So, anybody who took advantage of file and suspend was able to get that one check and allowing eligible family members to get half of those benefits. In the meantime, the individual's own Social Security benefit would go up at 32%. The reason I brought this up in this column is the fact that if you were born before April 30th, 1950, let's do the math here, Dan.
Yep.
That means they've already turned 70, right? Mm-hmm. They have turned 70. April 30th, 2020 is 70 years from April 30th, 1950, correct?
Yep.
If there's anybody out there who took advantage of file and suspend, I hope that they've contacted Social Security saying that they want to start drawing their benefits. Why am I saying that? Because Social Security is not going to contact you saying, oh, you're past your 70th birthday. You better start receiving your benefit.
Very true.
You know? And here's another sweetener in this whole pot. So the individual who did file and suspend did, in fact, at age 70, start withdrawing their own benefit. Meantime, for the past, let's say, 4 years, the spouse has been drawing 50% of what that individual's Social Security benefit was at full retirement age. Now the person is now 70. The individual is 70. Their benefits are what, 32% more? Yep. So now the spousal benefit is going to increase by 32%. So anybody who took advantage of file and suspend, and again, only for people who were born before April 30th, 1950, it's a wake-up call. Please make sure you file for your own benefits.
Absolutely.
Okay?
Absolutely.
So that is file and suspend.
So if you got in before April 16, good for you. Don't forget to start it back up. Don't forget to start it back up. Okay. Now, you cover a provision that was actually grandfathered in the 2015 bill, restricting an application. So what happens there? Okay.
Dan, I think this might hit home for you as well. Okay. Mm-hmm. Unlike file and suspend, the purpose of restricting an application is for the filer to receive his or her spousal or former spousal benefit, while simultaneously at the same time delaying their own benefit. Okay. Mm-hmm. So under current rules, an individual who has reached his or her FRA and who was born before January 2nd, 1954, is eligible to restrict an application. And what that means is, upon reaching their FRA, they can say, I want to receive half of my spouse's Social Security, half of my spouse's Social Security, or half of my ex-spouse's Social Security. Now, you would say, well, wait a minute. Didn't you just say a few moments ago, Ed, that you can't get, let's say, half of your spouse's Social Security if your own Social Security is more than half your spouse's under the dual entitlement law? I think I said that.
That's what you said.
You're under deemed to have filed, you only can get the higher of your Social Security benefit or half your spouse's. But under this restriction application, once you reach full retirement age, and if you were born before January 2nd, 1954, it makes no difference if half of your spouse's Social Security is less than your benefit, than your Social Security benefit. You can start receiving half of your spouse's. In the meantime, delay receipt of your benefit till, let's say, age 70, getting these delayed retirement credits. And then once you reach age 70, you can switch to yours, which will be 32% more. So, but this, again, I'm going to just give you the qualifications. In order to restrict an application, also it's called claim now, claim more later. That's another thing they call it. They call claim now, claim more later. You're claiming now on half of your spouse's, but then you're going to claim more later of your own. Number one, you have to reach full retirement age. You must have reached full retirement age. And number two is you must have been born before January 2nd, 1954. And here is another qualification. If you're drawing on your spouse's, your spouse must be drawing. If your spouse is not drawing, you cannot get half of their spouse's, of your spouse's. So, for example, let's say we have husband A. The husband is turned 67 years old this past Monday, not 66. They were born in 1953. 53. They've reached 67 years old. Okay? So they're past their full retirement age. So they reached 67, born on June 15th, 1953. And they have a spouse who is 64 years old. Okay. Is the husband eligible for restricting application? Yes, because they were born before January 2nd, 1954.
Right.
So far, so good?
Yep.
Spouse, 64 years old. Can the husband draw on half of the spouse's? Spouse says, I don't want to draw. I don't want to draw.
Well, if the
Why
spouse
wouldn't the spouse want to draw at age 64, Dan?
Because she would be reduced from her full retirement age.
That's correct. So the husband cannot restrict the application then. Now, one possible solution is if they divorce, it makes no difference what the former spouse is drawing. Because when it comes to an ex-spouse, the rule is if you're going to draw on an ex-spouse's, the only rule is that you must be at least age 62 and your former spouse must be at least age 62. It makes no difference whether the ex-spouse is drawing or not. I think that's a very expensive solution, though, to divorce your spouse just to get the restrict the application. Would you agree with that,
absolutely. Dan? Absolutely. Okay. Yes.
Okay. So, Dan, I think you mentioned that you were born in 1956.
Yes.
So you would not be a candidate.
All these dates do me no good.
Okay, this is good. Now, I just want to point out to you, Dan, that don't feel bad because, yes, I was born before January 2nd, 1954, but I can't do restricting an application either. I've never been able to. And why is that? Because as a CSRS annuitant, I'm subject to what's called the government pension offset, which means I can't get any of my wife's Social Security. Okay,
Gotcha.
It wipes it out. So I can't do. I could not do restricting that. I could not do restricting application. Okay, I couldn't do file and suspend because I was born after April 30th, 1950, and I cannot do restricting application. So I do have sympathy on you. I hope you have sympathy on me too.
I do indeed. And, so basically, everybody born after January 2nd, 1954, we're going to call them Generation Deem. Okay, because they're all deemed as soon as they file. We got our own name. So that way when somebody goes, okay, boomer, I'll say, excuse me, show some respect. I'm a deemer. And that'll get me out of that. So you come up next with claiming options for divorcees, and we get a lot of questions on those and a lot of misconceptions there. So let's go ahead and dig in.
Okay. The do-over option was never available to a former spouse who were receiving half of an ex-spouse's Social Security. Even this is before December 2010, because you're claiming half of the ex-spouse's Social Security. And again, if you decided, okay, I want to do, let's say, do it over. I want to stop those half those payments. They're not, when they start you off with your benefit, you're not going to get any delayed retirement credits. So it was never an issue with do over. Okay, and with respect to file and suspend, it's also not relevant because whether a divorced spouse upon reaching his or her full retirement age was always eligible for 50% of the ex-spouse's Social Security. Okay, whether the spouse they're drawing on was drawing or not, they could always get 50% of the ex-spouse's. The ex-spouse, whether they're drawing or not, the divorced spouse could always get 50% of the ex-spouse's as long as they were married for at least 10 years and been divorced for at least 2 years. So file and suspend was never an issue for divorced spouses. Okay. A divorced spouse, however, is eligible for filing a restricted application in order to obtain the ex-spouse's benefits while delaying the divorced spouse's own return benefits, provided the divorced spouse was born, again, before January 2nd, 1954. The divorced spouse and the ex-spouse were married for at least 10 years and been divorced for at least two years, and the ex-spouse files the restricted application at his FRA or later. I want to relate a story, talk about people don't know about this. I had a client, I still do her taxes. She came to see me back in 2014. At that time, she turned full retirement age, 66. She's still working, social worker, and good job. And she was trying to figure out whether she should start taking her Social Security benefits before now that she's reached her full retirement age. And she told me she intends to keep working. So we were talking about the benefits of waiting. I asked her, do you need the money? She said, do you need the Social Security now? No. I said, well, it would really be advantageous for you to wait then because you get these delayed retirement credits. But I do have to ask you a question. So I said, were you ever married? And she said to me, yeah. She was sort of hesitating. I said, it was a hesitation. So I said, tell me about your former spouse. So she said to me, he is, not was, a telemarketing executive, 6-digit salaries for years. He's 68 years old. And Dan, I'm thinking in my mind, here I got a great strategy. Here's my strategy. You are going to start drawing on half of his. Remember, she reached her full retirement age.
Yep.
She can do this restricting an application, okay? Because she's reached her full retirement age, and then you're going to at age 70 switch to yours, which will be 32% more. That's my strategy for you. This way you'll maximize your lifetime benefits. You'll get half of his, which will be a nice amount for the next 4 years, and then when you turn 70, you'll see that your benefit will be almost 1/3 more, and then switch to yours. But I do have to ask you one more question, though. How long were you married to him? And she said, 9 years, 10.5 months. Dan, I fell off my chair. I said, why couldn't you stay married for the minimum 10 years? You know what she said to me? She said, because my divorce lawyer knew nothing about Social Security. Did not advise me to stick around, stick in them, let the marriage stick around for 10 years. She lost that benefit because she was not married for the minimum 10 years. So here's an example where I call a financial professional should have known this. Her divorce lawyer, of all people.
Sure.
So,
or he should have had access to people who did.
Exactly.
Law's complicated. Stay in your wheelhouse, but there's certainly people that you can bring in. All right, now Ed, on the topic of divorce, I think we got to go out on this next one because in your article you kind of make a reconciliation pitch in the article here. Ed, I never knew you were such a romantic. But seriously, you do point out there is an economic benefit to remarrying. So why don't you touch on that quickly?
It's interesting. This new law, this came out of the Bipartisan Budget Act of 2015. If they were born in the same year and they both have contributed to Social Security, it might be advantageous for them to, and let's say they both have reached their full retirement age, they both could, let's say, they could consider divorcing and then remarrying. In the meantime, take advantage of restricting their applications on the other's benefits. It might be interesting, and then remarrying, then get their benefits back, and then this way they'll maximize their lifetime benefits. I'm not making a pitch here for divorce lawyers or counselors here. I just ran some numbers and found out this is one way they can maximize their benefits. But the bottom line is, ladies and gentlemen, you got to be happy. Don't let Social Security and divorce guide the way you're going to conduct the rest of your life.
But only Ed Zurndorfer would work those numbers through. That's why I love you, brother. So that's amazing. Okay, so let's round out the article by talking about survivor benefits post 2015, and I guess the good news is no changes.
No changes on survivor benefits. I think we talked about this in earlier podcasts about Social Security and survivor benefits. Yep. The bipartisan budget act of 2015, which got rid of file and suspend. It got with the restricting an application. None of this has any effect on survivor benefits.
Mm-hmm.
So nothing has been changed in that sense.
Okie doke. So another big topic that you've broken down for us and our feds. It's great stuff. Can't thank you enough for it. Folks, that's a wrap. And, be sure to catch the next podcast next month. Ed is going to just keep cranking out great topical information for you. And be sure to watch for Virtual Ed. Okay, literally, you can, I think we know now that we've had about 90 days of people wearing their shirt and tie and sweatpants when they go on their virtual meetings and things like that. You don't even have to do that, to be able to learn from Ed. That'll be up in the next week or so. And Ed will be back with us again next month on the podcast as we continue to reach, teach, and serve you. We are serving those to serve. Be sure to subscribe to this podcast on YouTube and also on Spotify. Remember to share it with friends and strangers. You cannot imagine how much misinformation there is out there. Share the podcast. Ed's always great. Frequently, I'm okay. So it should be a pretty decent, easy listen for folks. Check us out on Twitter and LinkedIn. Don't forget, our seminars are suspended, but we will be coming with Virtual Ed. You can read him every month in the Fed Zone at blog.stwserve.com and also at fed-zone.com. And so I will say to you, for Ed, the crew in Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed. For heaven's sake, take care of yourself and stay safe. And remember, it's your Fed life. Please make it a great one. because you deserve it. Stay safe, stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.